Hello, everyone. Happy Friday. Today on the Final Bar, we will wrap the week. We'll look at how this tumultuous, this choppy, this noisy, but net positive week has played out for equities. Risk assets overall moving to the upside. The S&P, the Nasdaq really pushing through, finishing the week strong, giving a lot of bulls that have been beaten down renewed sense of optimism. As if we've seen enough to sort of indicate a renewed uptrend, or is this the end of a bear market rally? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. Happy Friday. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the power of technical analysis. The technical analysis toolkit is uniquely designed to help us understand periods like this. Fundamental analysis, thinking about economic data, thinking about company performance and growth and earnings, all of that has value in your process. You will never hear me tell you otherwise, but it's all about what things are good for, right? The movement that has happened in the last couple of days, in the last week or two, I would argue is never going to be readily understandable by reading a bunch of 10Qs, by reading annual reports or anything like that. This is about the supply and demand in the market. This is about investors going through the different phases of bear markets. And overall, how price is a great indication of where investors are at. There's no doubt, given the strength that we see going into the close on Friday, the renewed strength, the sense of short-term optimism at least, right? Short-term optimism pushing the S&P back toward 4,200, eclipse 4,100 with no problem today. Is there further upside to this move? That's what we'll try to focus on here today. Now, we have great guests on the show. I had some really good conversations this week, and I'd encourage you to go to StockChartsTV.com to review our latest discussions, some of which have been just really fantastic. Next week, we have a couple of good guests lined up for you. We will be taking Monday off for the Memorial Day holiday, and we really appreciate so many that gave their lives for us, and we'll certainly appreciate the opportunity to do that on Monday. We'll be back with you live on Tuesday as we review the market performance or the market expectations for the week. We'll have a guest for you on Wednesday and Thursday next week. On Wednesday, the 1st, Dave Landry from DaveLandry.com. On Thursday, the 2nd, Jay Pettit from Charts Avenue coming to us from Singapore. Let's continue on today's show. Let's talk about how this week has played out. A lot of fascinating things to talk about. I do want to start with a poll, though. We ask a poll always on our live stream page at StockCharts.com/TV. Also on our social media accounts. So give us a follow on Twitter at FinalBarSCTV. Make sure you subscribe to our YouTube channel called Stock Charts. And here's what we asked you recently. Which of the FANG stocks performs best over the next 3 months? Facebook, Apple, Amazon, Netflix, Google. And I use the old names for those because that's how we're feeling today. Over half of you said Apple out of all of those two. Second, with about 24%, Alphabet, 24%. After that, it was sort of single digits for the other three. So let's focus on the two that most of us voted for, starting with Apple. You know, I didn't vote in this poll, and I didn't include Microsoft. I often call them the fan mag stocks and include Microsoft as one of the 6. If I did, I bet you'd probably split between Apple and Microsoft because they have kind of similar characteristics. Out of all of these names, Apple has probably held up the best. And I can say that definitively based on the relative strength that is still fairly strong, really hasn't underperformed by too much. It's been more of a market performer over the last 6 months, while others like Meta, like Alphabet have really struggled. Netflix, obviously, as well. The other one's Microsoft. And again, I didn't have this in there, but this is another one that's probably held up better than most, particularly in 2022. Underperforming, but not by much. You compare that with something like Netflix, Meta, with these big gaps, with consistent underperformance since November of last year. So at times, the FANG trade has been a trade. It's been one thing. Now you're starting to see them differentiated quite a bit. So I would agree with the majority of you that voted for Apple. If I had to pick one, that's probably the one that I would be in. I would argue that is not the best place for you to be overall. given the other opportunities that may exist out there. But not a bad bet out of those 5 stocks that I gave you as options. Thanks again for voting in the poll. We'll keep them coming. And we have another one running live on our live stream page now. Let's continue on as we wrap the week. So the wrap the week segment is really about looking at the last 5 trading days and just seeing how things have evolved. I'm going to include Bitcoin in the mix because it was kind of in the middle of all of these through the course of the week. Here's how things netted out. Follow my mouse and my voice and you'll make sense of what's happening here. Toward the top, we have the S&P. So in previous weeks, in much of 2022, actually, when we've done this wrap the week segment, we've talked about how the S&P is sort of in the middle or often at the lower end, and all these other things are kind of outperforming. This is a pretty decent week for stocks overall, with the S&P up 6.6% as of today's close. Very closely overlapping there in purple is the Russell 2000 small caps, which finished the week almost identical to the S&P, up about just over 6.5%. The big winner for the week, the Nasdaq 100, the Qs were up 7.1%. Decent recovery week for that area of the market. There's absolutely no doubt about that. Everything else underperformed the S&P this week, including crude oil prices. This is the USO, which was up 4.7%. In orange, we have emerging markets finished the week up 2.2%. Just about 0.5% higher for the week. We have 2 different ETFs, the TLT, which is a long bond ETF, and the gold ETF, GLD. So essentially flat for the week, just a little bit above zero. These other 2 were actually down for the week. I was actually surprised that Bitcoin is only down 0.8% for the week. That's taking it from last Friday to where we're at now. Obviously, Bitcoin and most cryptocurrencies trade 24 hours. So we're looking at just the sort of normal trading sessions to keep it in line with these other ETFs. But currently, down 0.8% for the last week. In green, we have the US dollar, which is down 1.4%. I did a panel. We didn't have a show yesterday because I did a panel for fidelity, a panel for fidelity. John Gagliardi, who was on the show a couple of weeks ago, invited me to be on a panel, and JC Peretz from All-Star Charts, who's on StockCharts TV pretty regularly. The 3 of us were discussing, along with Jared Blickray from Yahoo Finance, and we were talking about just overall environment. And JC's point was the weaker dollar. That's the story, and it's hard to disagree with that, given the fact that is changing. And I think a lot of what we do as technical analysts is thinking about the markets, right? Thinking about this overall environment and what's different, right? If things are in a particular trajectory, what all of a sudden starts to be a little bit different. I want to bring up the chart of the USD. Here we go. So here's the dollar index, which on our platform is $USD. And if you look, this is what we're talking about here, right? The dollar index got up to 105. All of a sudden, it's down almost to par, down to 100. Last time I was there was in mid-late April. So this is quite a drop here, almost what's called a 4% drop from 105 down to just under 102. That's a pretty big move after, and really the biggest pullback that we've seen in the dollar index since the bottom back here in May, right? You had the bottom in the beginning of 2021. Quite a pullback where we pretty much gave up 100% of that into the low in May of last year. The last 12 months have essentially been very, very strong, but you see how that accelerated to the upside. So when it's accelerating, it's very easy to think, all right, at some point we have a pullback that's probably going to be pretty quick and pretty painful. The more things accelerate, the more things tend to just rip right back down as the buyers are exhausted and there's nothing left for the chart to do but go lower. And the question now is, how low is too low? I'm certainly eyeing the 50-day moving average, which is just above 101. Got a little bit more room back to there. But, the 50-day moving average tends to track the price pretty well. And you can see during this uptrend, a number of times where the dollar index got back down to the 50-day, even undercut it a little bit, but in the end, sort of continued to resolve lower. So if and when we do hit the 50-day moving average, that might be enough of a pullback in the dollar. However, what happens if the dollar goes materially lower than here? What does that mean for U.S. stocks versus non-U.S. stocks? And the hint is it's not great, right? That means U.S. most likely underperforms non-U.S. or global markets. What happens if the dollar index rips to the upside, goes to 110, 115, 120? Possible, absolutely. Likely, not necessarily, but those are the scenarios that I would think about with the dollar index. And then just think about some of the names that you hold, some of the ETFs that you hold. Would that present more of a tailwind or a headwind to your current positioning? And that is certainly something I would encourage you to be thinking through here. Just to finish up on today's move, obviously equity is moving to the upside. I'm resisting the temptation to say a rise in risk assets because one particular generally accepted risk asset, which would be cryptocurrencies, not participating in the upside in equities this week. We'll get to there here in a few moments. But the S&P finishing strong this week, up 2.5%. The Nasdaq Composite up over 3% today. Mid caps and small caps all up over 2%. So this is a strong finish to the week. It shows you that, especially on that tactical time frame, you're getting people believing in this short-term strength. The question I would always try to take from there is, at what point is this a short-term trend that turns into something longer, right? What is the bigger thing? And the answer is a couple different things. Number one, we look at price behavior and we see what we do relative to key support and resistance levels. Number two, we look at breadth conditions to see if you get confirmation. You see stocks that are making new highs and evaporation in new lows. Those are the sort of indicators we would look for. We'll cover a couple other concepts as we go on here. The VIX, by the way, well below 30, just below 26 today on Friday's close. Interest rates mixed depending on where you look out on the yield curve. The 10-year point, which is where we usually track, is down around 274. Now, this is down from over 3% not too long ago. So you've certainly seen rates come down, just like the dollar has come down here in the last couple weeks. What's different here is that bond prices are actually starting to work a little bit. And when equities have been struggling, you've seen equities struggling, but you've not seen bonds rally as sort of the safe haven train. That's changed in the last couple of weeks as the TLT has rallied a little bit. Sort of a choppy finish to this week, but that's certainly a key metric to watch going forward. Commodities overall finishing in the positive, but gold was not a super nice, super great follow-through chart. Yesterday, the GLD was up pretty good. Today, it really finished more unchanged. It was more in line with where we closed yesterday. Cryptocurrencies, all 10 of the most liquid coins that we follow in the red today. You have Ethereum down 1.5% here, below 1770. You have Bitcoin well below 30,000, actually undercutting 29,000 yet again in the last couple hours. This is a key one to pay attention to because, again, I think a lot of times we like to oversimplify and think if stocks are doing X, Bitcoin or Ethereum or gold or bonds should be doing Y. Remember, there are a lot of moving parts in these markets for sure. Just finally, strength in some of the offense, right? Consumer discretionary up over 3%. Same with technology, followed by REITs, which is really more of a defensive sector, up almost 3% today. On the bottom, you have some pretty pure defense, like consumer staples, like utilities, like healthcare. Now, all of those, the worst sector still up 1% today. So this is very much, again, flows back into the equity markets for now. And again, the question in this sort of environment is the sustainability of those potential gains. Let's finish off looking at the Mindful Investor Live chart list. Just briefly wanted to mention that our short-term market timing model as of today's close turns back positive. This is exactly how this market feels to me, which is why I like how this model sort of matches how I would subjectively think of this market. What this market feels to me now is a long-term downtrend, a medium-term downtrend, which is my main sort of time frame. This is my main risk on, risk off. So it still tells me to be thinking more risk off than risk on here. But the short term, the tactical model turning back positive. It's been a strong week, finishing at the highs for the week. That's a nice resumption of this uptrend, or a nice return to a bit of a bounce. The question again is the sustainability. When we think about sustainability, it's about breadth, right? And it's worth noting, I mentioned a number of times how the S&P advanced decline line has not made a new low after March, right? In May, all the other ones did. The S&P did not. If we do rally significantly here, if the S&P gets to 5,000 in the next couple months, which I think is unlikely, but certainly possible, this is the chart I will look back on and say, I should have caught the fact that the S&P advanced decline line made a higher low, right? Not so far, indicating, lack of downside breadth and downside follow through for the largest market moving stocks. Let's take a quick commercial break. We'll be back with our next segment, the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us for our show every weekday after the close. A couple quick announcements before we get to my next segment. First off, we welcome your questions. We're going to do a mailbag segment here in a few minutes. We'd love to answer one of your questions live on the air in our next mailbag segment, Tuesday of next week. Go to your email, thefinalbar@StockCharts.com. That's the best way to get your questions in front of us. You can check us out on Twitter at FinalBarSCTV. Just tag us in a comment there or comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air next week in our next mailbag segment. Also, go to StockChartsTV.com. That is our on-demand platform. We have such great content. We just talked to Larry Williams, who will be doing a new market update special next week. You'll see that live on Stock Charts TV, but you also can watch it at your leisure for free at StockChartsTV.com, along with all of our other great programming and specials. Also on your mobile device, just search for Stock Charts TV on demand. I want to continue on today's show with our next segment, Power Up. What we like to do on Fridays is take a few moments just to highlight one of the features on the Stock Charts platform that we find people are under aware of, if that's a word, right? Should be using more as part of your disciplined use of technical analysis and the Stock Charts platform. A lot of the stuff we'll talk about is on the Charts and Tools page. So if you click on that in your Stock Charts login, you'll get a bunch of different things that we have. And I want to focus on the CandleGlance function. This is something we use every time we do the show because it's really become a core part of how I use the Stock Charts platform. But I want to highlight a couple of things. Just want to highlight a couple of things today that I think people aren't as familiar with. Number one, if you do what I did, which is go to Charts and Tools and then bring up CandleGlance, you'll see what's called our U.S. equity market overview. It's really more of a broad, not just equities, but currencies, commodities, interest rates, all sort of in one page. This is something that our contributors over time, we've sort of identified the key groups of indexes, ETFs, and different market indicators that we think help us understand the current state of the market. So, as part of your morning coffee routine, this would be a really decent thing to bring up to just get a sense of what's what. And you can see the quick movements, you can see the percent returns, you can see the charts over the last year. Now, I will come back to the fact that I am using a custom template that I've created particularly for my CandleGlance chart. So I have a daily chart going back for 1 year with the 50 and 200-day moving averages. You will see right at the top of all of these, there's this little gray line that says Stock Charts members, customize your CandleGlance charts. So if your charts look different than mine and you want to create your own custom chart that all of these CandleGlance charts will use, just click on that blue indicator. It'll tell you how to do it. To the right of where it has all those tickers listed out, it says predefined groups. We have all of the major collections of stuff, ETFs, indexes, indicators, equities that we think are most helpful for most investors. We have them already preloaded. So you don't have to create a chart list and go through all these steps. You just click on here. So I'm looking at the 11 S&P sectors along with the S&P 500 itself. Further down, and this is why it's really helpful if you're talking about hardware, talking about gaming stocks, talking about grocery stores, we have all of those indexes and equities preloaded as industry groups. This is using the Dow industry groups that we use. So if you want to know what's going on with biotechs, how the biotech industry looks, and then some of the largest names in those industry groups, this is a really good place to just start your thought process, right? Take a good 30,000-foot view of the space and then figure out where you want to dig into. And clicking on any one of these charts obviously allows you to use the Sharp Charts feature to dig into it a little bit further. So to power up your use of Stock Charts, I would suggest today use the CandleGlance function and look at the predefined groups area. Go through some of those and you'll find there are a lot of great ways to just help you think about how you think about the investment landscape. Let's continue on and answer your questions from the Final Bar mailbag. As a reminder, our email, thefinalbar@stockcharts.com. Keep your great questions coming. And here's question number one. Whatever happened to S&P 3850, which was the downside target you set for a long time? Now you're setting the target lower. When will you get back in? Aren't you worried you might miss the final rally? I've gotten some questions on this. I part of this show is, of course, talking about what I'm seeing and making observations about where I think things may be headed. And as always, I'll make it clear it's not a recommendation. And I certainly don't know what's going to happen tomorrow, and no one does. I can make educated guesses based on the best practices of technical analysis and based on my own experiences with market history. And hopefully that sort of experience is valuable in this sort of environment because, many newer investors have not really weathered a painful bear market. And painful is certainly a word I would use to describe this sort of choppy but net negative experience. Having said that, what happened to that price target? So yeah, the way that price targets work in my world, the way that I think about them, and others may answer this differently, but I do not super follow a particular price target and that's it, right? So if I say the S&P is going to hit 4,400, and then back here in July of last year, we hit 4,400. So I would sell everything and say, all right, we hit 4,400, you better go short. And the reason why that's true is because my time working for long-only equity mutual fund managers, my time at Fidelity and working in my previous parts of my career with money managers, price targets were interesting, but they would never change their positioning because if something worked and if something was up 30%, you'd never want to sell that just because it was up a lot, right? Up a lot is good. That's what we want. So we would continue to follow those trends. When you hit a price target, that tells me to switch fully into trend following mode. All right, we've reached the target. That's great. Now let's see if this continues to go. Let's make sure we bring our stops all the way up. So if it goes down at all, I've locked in all of those gains that we've experienced so far, and I minimize any potential downside. And so that's the same thing I would work here. When you're thinking about the market hitting a target, the question is, do we hit that target and do we establish it, right? Do we confirm it? I think what's happened now is we've reached the downside targets I've been talking about. It's been sort of 3,800, 3,850, depending on how you come up with those levels. Those Fibonacci levels are all in the 3,815, 3,820 range, if I remember right. So we have certainly reached that. And what we've talked about in the last couple of weeks, I would be blown away if we reach that kind of level and then just continue to go down. So I think what's happening right now is 100% anticipatable, if that's a word, because you would expect buyers to come in. The question now is the sustainability. Getting above 4,100 today on the close, getting above the 38.2% retracement of the shorter term time frame is making me interested about the potential for further upside in the short term. I remain super skeptical because of some of the other things we've talked about, the breadth conditions, the long-term trends, which I would argue still remain negative for a lot of stocks. The end of your question, though, is very telling. Aren't you worried you might miss the final rally? Absolutely not. And I think a lot of times individual investors in particular worry way too much about picking the bottom, way too much about picking the top, and nervous you're going to miss it. It's okay. And I would be totally fine with missing the beginning of a move and minimizing the chance that I'm buying in on some sucker's rally that drives up quickly and then rolls right back over. That's why you use scaling into positions. That's why you limit your exposure. That's how you look for confirmation from different indicators. And then worrying should certainly not be something hopefully you're doing, thinking about the beginning of a new uptrend for stocks. Great question, though, and thank you so much for that. Question number 2, you talk a lot about relative strength on StockCharts as well as on The Mindful Investor, which is my blog on StockCharts.com. Does StockCharts have a way to run a scan for relative strength? And the short answer is yep. We have a couple ways. I will tell you right off, this is one of the areas of development. We're actually looking on redesigning our scan engine from bottom up, and we're going to do some really cool stuff with it. Can't tell you a ton about it because it's very much in development, but we were debating all the things that we would like to include in there. And a lot of you have sent great feedback on that. And I encourage you to continue to do so if you have specific ideas. 2 things I would suggest to you. Number 1, we do have an argument, and there's one, let's see, where is it called? I have one called Correction Long Ideas Based on Relative Strength. And if I edit that scan, this is the line you want. It's called PCT relative, which is basically the argument that says the percent, the relative strength. And after that, it's the number of days or the bars and the relative indicator. So I'm doing $sign SPX greater than 10. So what I basically said is I only want things that have outperformed the S&P by at least 10% over the last 20 trading days. And if I run that scan, I'm going to get 58 stocks that have done that. And it's things like Albemarle, nice bounce higher, right? It's had a bit of a breakout. This is what it's actually looking at. It's saying this line is up at least 10% in the last 20 trading days. So that is what I use most often to scan for stocks that are showing strong relative strength. You just need to work with those arguments and refine your screen a little more to figure out what you want. The other thing that I would tell you is using the scooter rankings, right? The StockCharts technical rankings are based on performance, which means a higher ranking is most likely outperforming the S&P over some look back period. So here I'm looking for stocks with a scooter ranking above 90. I'm only looking in the financial sector. And if I look at that list, it's a handful of names that are showing strength. It's things like Progressive, right, in the insurance space that have been performing well and are in the top ranked stocks in our entire universe. Those are the 2 tricks I would use to scan for relative strength on StockCharts. More to come, but at this point, those are the best ways I've found. Next question. I noticed some oscillators seem to provide the same results more or less. Think stochastics, PMO, PPO, etc. Why would someone use one over the other? Is there enough difference between oscillators that one would provide a contradictory signal? Really good question. And the short answer is yes, there's a good amount of overlap between all of those. Any oscillator like RSI, stochastics, PPO, PMO, there's going to be some relationship. There will be subtle differences. And what I have found is just looking at the contributors on stock charts, different contributors will have different preferences. We had Erin Swendlin in our office in Redmond earlier this week. I asked her this question. She answered PMO. Now, her and her father designed the PMO, so I'm not surprised that that would be her answer because that's what they created because they wanted to create their own way to analyze price momentum. I tend to use RSI more than anything to measure price momentum. I've learned that. That was one of the first indicators I ever used, and I found it to be an incredibly great way. And talking to people like Connie Brown and others that have really used that indicator. Andy Cardwell comes to mind as well. I've sort of embraced the RSI as my main one. Katie Stockton, who comes through StockCharts TV, always uses stochastics more than anything. So I think you found that different technical analysts gravitate to one. It's usually what our mentor used or what we were first introduced to. I would not duplicate those kind of indicators because it's only going to confirm itself. There's very little, from those different kinds of indicators are all of the same general thing. Now, using something like PPO along with something completely different, like moving averages, like parabolic systems, like a trailing stop indicator, like Bollinger Bands, which is measure volatility. Now we're into something really interesting because you're looking at different techniques with very different calculations, different derivations, and looking for agreement. So that's what I would encourage you to look at. That's all the time we have for the mailbag. Please keep your great questions coming. We'll get to more next week, but we need to wrap the show and go to the 3 and 3. Let's go through 3 charts in 3 minutes to tell the story of this market environment. We have to start with my market trend model. My market trend model has been completely negative for the last couple of weeks. 3 Fridays ago, is that right? No, 2 Fridays ago today, my long-term model turned negative for the first time since summer of 2020. That was a big shift, which tells me that overall, this is a very much a bear market phase, which I think has been clear well before 2 weeks ago, but that sort of confirmed it. My main risk on and risk off indicator is my medium-term trend model, which remains very much negative, which is why I see this short-term bounce still as a bear market rally. The move that we saw going into Friday's close has indeed pushed my short-term model back bullish. So it's long-term bearish, medium-term bearish, short-term bullish. That tells me to continue to think of this as a bear market rally until proven otherwise, until these models turn back bullish, which tells you there's been enough of an improvement to signify a rotation back to a bullish phase. Chart number 2 is the 10-year yield. When I was asked in a panel earlier this week, a most important chart to watch, 10-year yield is still it. And I think when you're thinking about the short-term moves, thinking about the last couple of weeks and this sort of bounce, the reason, one of the non-technical reasons perhaps that I would argue that this is a bear market rally is to really ask you how much has changed in the last couple of weeks, right? Has enough changed in the last week that this big rally makes sense? It would make sense that stocks should bottom here. Not really. I think the same headwinds for growth stocks that were there 2 weeks ago are still very much in play. We have inflation that's essentially out of control. We have the Fed that has switched from being incredibly accommodative to incredibly unaccommodative. And we have all of those headwinds to growth stocks, right? We have the issue of what higher rates usually represent for those stocks, because basically the growthy part of growth is not that appealing anymore. Higher interest rates are usually much better for value stocks. Now, what's happened in the last couple weeks, though, in the month of May, you had that final push higher as the 10-year yield got above 3%. From there, we're back below it around 275. Value really hasn't underperformed that much, though, right? Because everything's kind of been struggling overall. So the value to growth ratio is actually remaining stable. If you think rates are going to continue to go down here, most likely that starts to hurt value stocks a little more than what we've seen so far. So far, it's been cushioned from downside compared to growth. Finally, IBM. When I'm talking about growth stocks, these are the stocks that come to mind. This isn't really a pure, plain vanilla cup and handle pattern, but it certainly is a basing pattern, which is a level of resistance that has been bumped into a number of times, potentially, going above there, making a new closing high for the last 52 weeks. Today, keep an eye on those sorts of names showing renewed strength. Folks, that is our show and a wrap for this week on the Final Bar. I want to thank you so much for joining us every weekday after the close. All of our previous interviews and episodes at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great long weekend. Happy Memorial Day. We'll see you on Tuesday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.